New to crypto and scared to death about making a mistake that could cost you everything. Trust me, you're not alone. I felt the same way when I first started. So you've come to the right place because we're pulling back the curtain and we're gonna reveal the number one mistake crypto newbies make. So stick around because you don't want to miss this video. Let's cut to the chase because the single most destructive habit that lands newbie investors in hot water is, drumroll please, herd mentality. Yep, you heard that right. You follow the crowd thinking safety in numbers, right? But it could be far from the truth. Herd mentality leads to two major emotions that create huge irrational mistakes: fear and greed. Two emotions that have caused a lot of people to lose a lot of money. Let's dive into why this can be a one-way ticket to disaster in the world of crypto and investing in general. Let me take you on a journey, a painful but one of the most important journeys of my life inside crypto. Picture this, the year is 2021. I've been trading Bitcoin successfully since 2018, amassing over 150% in total returns. Things were looking good, they were looking great, and I felt invincible. And one day when I was scrolling through my Twitter feed, I wanted to see if the Twitter hype was real. So I ventured into higher risk altcoins because the chatter was deafening. People were talking about doubling, tripling, even 10xing their altcoin investments. So what I did was I diversified. Well, I more like scattered my investments into more than 30 different risky altcoins. And I felt like I was playing a slot machine where I only knew which machine would pay out. I was feeling like King Midas himself, and I was on this crazy winning streak where everything that I touched was gold. It felt like at the time I couldn't pick a losing investment. I got so caught up in this whirlwind of emotions that I even invested 10,000 of my wife's hard-earned money. And what was my risk management at the time? What was I doing to make sure that I was taking profits and making smart decisions? I wasn't doing any of that because I got caught up in the euphoria and the herd mentality that things weren't slowing down anytime soon. Then came the reckoning. I was on a bachelor party cruising in the middle of a lake, feeling on top of the world. By the time I checked my phone, the crypto market had crashed. Bitcoin, the fortress of the crypto world, had plummeted. Bitcoin had crashed from 65,000 in April 2021 to 35,000 in that June. You know what that means for altcoins, right? It's a catastrophic free fall because they're affected even more. My portfolio was decimated, 80 to 90% of it was eventually wiped out, and the worst part was that I lost my wife's money. This is money she trusted me with, and it was one of the hardest moments of my life. And as bleak as that was, it became one of life's greatest teaching moments for me. It was a wake-up call, a cold shower that made me revisit my strategies, my mindset, and most importantly, my humility. It's what driven me to share that experience with you today, and I'm laser focused in helping you avoid those pitfalls of following the crowd and getting swept up in the kind of greed that nearly destroyed me. If my story resonates with you and you want to avoid making some of the same rookie mistakes like I did, hit that subscribe button, ring the bell, because I've got more valuable insights and experiences coming your way that you don't want to miss. But before we go any further, let me add this quick disclaimer. This content is for informational and educational purposes only. I'm not a financial advisor. This is not financial advice. Always do your own research and consider consulting a financial professional before making any investment decisions. Now, let's get back to it. Before we dive into how to keep those emotions from derailing your crypto journey, let's go back to square one. The universal mantra that should be the guide for every investment decision that you make is simple. It's going to be buy low and sell high. Sounds simple, doesn't it? But just because something is simple doesn't make it easy. And the difference between trading and investing boils down to how long you're going to hold the asset for. Are you in it for the short haul? Then that's going to be trading. Are you looking to build wealth over a longer period of time? That's going to be investing generally. But regardless of your approach, the fundamental goal is the same. You're going to buy at a lower price and then you're going to sell at a higher one. And now ask yourself, would you buy high and sell low? Depends. And that's where rationally thinking about it needs to come into play. Instead of just following other people's plans, you need to be able to create your own plan and take in information from other sources to see if it makes sense for you. But emotions like FOMO, which is essentially just greed, or FUD, which is just crypto slang for fear, uncertainty, and doubt, we just simplify that to fear, makes beginners and everyone do exactly that. Go against their plan when they should have made a more rational decision. So why do these emotions lead us off course? When you're in FOMO mode, you see all of these prices soaring. Everyone seems to be winning except you. And then you think, why am I not winning? Why not me? So without sufficient analysis, you might just jump in when prices are peaking. And in many instances, this means you're buying high. And switching gears, let's talk about FUD, fear, uncertainty, and doubt. Maybe you hear some troubling news, you hear all these headlines, doom and gloom everywhere, and your investment has already taken a nosedive. Your instinct might be to cut your losses and exit. And in some cases, this leads to selling at lower prices, which might not be ideal for your overall plan. But again, it depends, because you need to go back to your original plan to see if that decision makes sense. But oftentimes, holding on to a longer term asset, especially when your original plan was just to be a long term investor and hold for the next 10 to 20 years, what these emotional events are happening in the shorter term shouldn't matter, as long as your plan is still the same and the fundamentals of your plan haven't changed. So how do you steer clear of these emotional pitfalls? The first step is recognizing what's driving you. If you feel that sudden urge to buy or sell, just take a step back, breathe, and then ask yourself 3 questions. Is fear or greed affecting me? 2, where is this emotion coming from? Is it market trends? Is it social media? Is it an emotional event? Maybe it's from a reputable source, from a friend, from an analyst, somebody who dives deep into this work, and their information makes sense within your overall plan, your investment horizon, your own risk tolerance, and everything else with your plan. 3, is my reaction rational? Am I thinking of buying or selling based on comprehensive analysis? Or am I just getting swept up in the moment? Am I actually applying different information into my plan and looking at if it makes sense? Or am I just being emotional? Especially if you're a long-term investor, sometimes it's actually better to hold onto an asset than sell it in a panic. So one of the things you want to ask yourself, 1, have the fundamentals of the asset changed? If not, ask yourself, why are you selling? 2, what does your research say? Are experts in the field suggesting that this is a temporary turndown? You want to get the full spectrum of differing opinions so you can make a better educated guess and better analysis. But that's just the first step. Because emotions have such a negative impact on a person's investing journey, what I did personally was I tried to learn from some of the best traders and experts and adopt their strategies and how they handle the emotions. So what do they do differently? Well, one of the biggest things is they have a plan, and they plan rigorously and they stick to it. Legendary trader Jesse Livermore once said, the market is a device for transferring money from the impatient to the patient. So we want to be the patient one. And the way that you be a patient one in this market is, first, you need to start by planning. Before you invest or trade, establish a plan. It should outline your goals, your risks you're taking, the exit strategy that you're going to have, so that when your emotions are high, your plan is going to keep you grounded. 2 is understanding the difference between long-term and short-term strategies and trades or investments. The longer term your investment horizon is, the easier it is to handle emotions. So you should be applying the information that you get at time horizon, and if it makes sense. If it's just short-term noise, it won't affect your long-term investment horizon. The longer your investment time horizon, the easier, in my opinion, is to handle emotions, because a lot of the short-term stuff is just noise. Timing becomes less critical, because when you find an asset that you believe in the long term and you believe it'll be at a higher price in the future, whether it's going to be 10 to 20 years from now, it doesn't matter what the price is right now, as long as it's still within range and you're going to be profitable later. timing becomes less critical. In fact, a study by Dalber and Company shows that the average investor underperforms the market mainly due to poor timing that's often driven by emotional decisions. So let's dive into long-term investments and why timing is less critical. One of the things that saved me from total ruin was having a long-term strategy and plan in place. I kept a long-term portfolio of Bitcoin and Ethereum that I didn't trade and was just holding on to and just accumulating for the long term. This was to balance my short-term risk because I knew altcoins were higher risk, higher reward assets where I could potentially lose a lot of money, which I did. And I didn't take profits and I wasn't smarter about what I did, but those were all learning lessons. And what's more important is that if I had just held and placed that into just longer term, more fundamentally sound assets, I would have just been better off for the long term and I would have made a lot more money with less stress. So sometimes it's easier for most people just to be a longer term investor. And let's think about this in the way of tech stocks in the early days of the dot-com bubble. As we know, there was this big, massive tech boom and massive dot-com bubble and crash. Companies like Amazon were trading for $100 at the peak in 1999 and then crashed to $10 a share in 2001. Fast forward to today and we're looking at shares worth more than $3,000 each. If you had bought Amazon at the peak at $90 to $100 per share during that peak and you experienced that massive drop, herd mentality and all that fear might have caused you to sell. But if you held on, your returns would be astronomical, especially looking at it and you believed in the fundamentals of the company and that it could be a company that would survive the next 10 to 20 years, you could just hold. And that is approaching with a longer term strategy. And that brings us to an important principle that time in the market often beats timing the market. Fidelity studies reveal that investors who sold off their equities in their 401ks missed out on gains up to 37% over a 10-year period. And S&P data also shows that missing just the top 10 trading days over the past 20 years could halve your potential returns. 50% of your potential returns could be gone if you miss 10 of those days. So what's the takeaway? Consider dollar cost averaging. With this strategy, you invest a fixed dollar amount into an asset at regular intervals, no matter its current price. This approach is especially effective for volatile assets like crypto and serves as a good emotional buffer against fear and greed. According to Vanguard, dollar cost averaging can lead to higher portfolio returns over the long term when comparing to trying to time the market. And let's be transparent, this strategy only works best with assets that you strongly believe will survive and thrive in the long term. And even then, we can't predict which ones will survive, so that's still a risk. And as it stands, many crypto experts and institutions are placing their bets on market leaders like Bitcoin and to a lesser extent Ethereum. But anything can happen over the course of 20 years. So it's critical to stay up to date with the crypto landscape and understand the risks that you're taking. While there's no one-size-fits-all approach, understanding these core principles can help you make less emotionally driven mistakes, potentially saving you from getting wrecked when fear or greed clouds your best judgment. If you're new to crypto and want to steer clear of these pitfalls that snag most newbies, hit that subscribe button and ring that bell. And in our upcoming video, I'm going to share a specific strategy that helped me recover from this devastating crash. Trust me, you're not going to want to miss it. And if you like this video, check out this next one. I think you'll like it as well.